I just want to say that I'm really pleased to be able to host Arian tonight because, well, I'm interested in two reasons. Firstly, because I think economics, my profession, doesn't think half enough about what money is and what it's for. And that's something that indeed, and that's something that it's very difficult to change, unfortunately, even from within the profession. I always say I'm a professional in economics in the 5th best business school in Britain, no bugger listens to me. So what chance anybody else has, I have no idea. But we are trying, so I'm interested in terms of trying to instill in our politicians and our civic society more deep thinking about money and currency. And secondly, really, I'm particularly obviously given tonight's subject the idea of a public bank. What that is, what that might be for. You know, we know that the private banking system has not done well for Wales. Even when somebody like Professor Dylan Jones-Evans, disagrees on virtually everything, apart from the fact that beer and City Army is okay. When somebody like Dylan, concludes that the private banking system has done Wales many disfavours in terms of its regional development over recent decades, then we know that something is wrong. And a different approach to banking needs to be done, particularly for regions which are struggling in terms of appropriate finance delivered appropriately. So I'm really pleased that Alan's been going to talk.
Thank you everyone for coming this evening. It's great to see some familiar faces and some new faces here as well. My name's Justin Lilly. I'm representative of Positive Money UK. This is a campaign set up a few years ago now to look at the way that money is created and to see if it is worth reforming the way that money is created so that it could be better used in the public interest. But what I wanted to talk briefly about today was the idea of quantitative easing, something that I'm sure many of you have probably read about in the press. So between 2000 and 2005, the UK government, or the Bank of England, printed £375 billion worth, which was injected directly into the stock market and the bond market. The result of this was that it pushed up the price of bonds and shares, but it didn't actually fulfill the purpose of what it was set up to do, which was to get banks lending again to businesses. So the very reason quantitative easing was put in place, it did not succeed. It failed. But this is not something that you will hear the Conservative government or the Labour Party, for that matter. Neither of them will really admit that quantitative easing has been a complete and utter failure. So the UK government did stop quantitative easing in 2005, but almost immediately afterwards, the European Central Bank decided that it would be a good idea for them to start quantitative easing. Since then, they have printed £60 billion of euros, or 60 billion euros, I should say, every month. Okay, so this money again is going directly into the financial sector. It is not going into the real economy where it is most needed. So last week there was a debate in the European Parliament led by the Green MEP Molly Scott-Cato, along with a number of others, who talked about the possibility of quantitative easing for the people, or people's QE. Now, this could come in different forms. One that is being discussed is called helicopter money, where this money would go directly into the accounts of European citizens. They would then be able to use it to pay off debts, to spend, to save, whatever they would like to do. But the advantages of doing this is it is much more direct. It goes straight into the economy. It's going to increase demand much more than the traditional QE will. And it's going to actually benefit real people. It's going to make a meaningful difference. Other things that they could look at doing is invest in infrastructure, invest in renewable energy, provide enterprise guarantee schemes or very, very low interest loans for small businesses to help businesses grow and to help startups, particularly here in Wales, but also all over the Eurozone at the moment. So to conclude, the system that we've got at the moment of quantitative easing is going to push up prices, it's going to make the rich richer, it's going to have no discernible benefit for the average people in the EU. And that's it for me. I will leave it there for now. I'm now going to pass you over to Ian Jenkins, who's going to tell you a little bit about public banking.
Good evening everybody, and welcome to Cardiff University, Croeso. My name is Ian Jenkins, and I'm going to start by telling you a little story. I came to look at this type of thing, to look at banking, to look at the reform of banking. In 2007 when the crisis happened, and I realised that I had no idea what was happening. I looked at it, I read about it, I thought I genuinely don't understand this, and so I decided to start looking. I read some books, went online, did some research, and one of the names that I came across was Ellen Brown. And I started reading some of Ellen's work, and along with others, Ellen taught me how banks actually worked. I had no idea about this before I read it. I don't know if anybody else went through a similar epiphany when they realised that banks weren't in fact piggy banks, that Mrs. Jones put money in and then lent to Mr. Davis for his business. They actually created money from nothing. And the realisation of how the credit function actually works was a bit of a shock to me, and I started off being very angry, and I've stayed pretty angry, to be honest, about the way it works. Now, what we've seen over the past 30 years, possibly more really, is money that banks create as credit, instead of being put into useful functions, as Justin said, lending to small businesses, lending to infrastructure. What we've actually seen is that this money has been created for speculation and for what's called asset price inflation, where you take things that exist already and by pumping money into them, you increase their price. Now, has anybody here had their house triple in value in the last 30 years? Hands up. Yeah, just about everybody would have thought if you own a home, it would have doubled or tripled in value.
Not
Now you have...
Not Pontypridd.
Not in Pontypridd. Well, they doubled or tripled in Merthyr, so I assume Pontypridd's got a very similar price index on its houses.
I bought mine in 2008, so...
So not for you, not for you. No, it all went downhill after that. No, you're quite right. What I realised when I read material by people like Ellen Brown, I also came across people like Michael Hudson and other heterodox economists, who I didn't realise were heterodox economists because I wasn't an economist, so I didn't have any prejudice on that. I realised that what we have in the credit function is an incredibly potentially positive function. Something that can create new goods, create new jobs, create new infrastructure, but instead it was being used in a manner that was completely opposite to that, to the benefit of a tiny, tiny, less than 1% of our population, who were getting fantastically rich and paying themselves enormous amounts of money because they could. Now, what Ellen has done, I assume she started somewhere near where I was originally, because Ellen was not an economist by training, she was a lawyer, like myself, actually now. I wasn't when I started this off. Is to research the idea of a public bank. Now, does everybody know what a public bank is? The basic idea of a public bank.
One that's owned by the government.
Correct. So
Not
instead
for
of...
profit.
Well, yes, not for profit, except that the profits from loans can come back to the state.
Yeah.
So they can be used for useful purposes. Banks don't have to be rapacious private organisations. The credit function, the function of a bank, can be used by the state to invest long term in manufacture, in small business, in infrastructure, and the returns of that come back to the state. Ellen has looked right across the world at places where these banks are actually the norm. These aren't a strange aberration as they would be here. In fact, there are only 3 countries in the whole of Europe that don't have public banks, and that's the UK, Lithuania, and Cyprus. So we're in good company, because the Lithuanian and Cypriot economies are fantastic at the moment. But what Ellen has actually shown in her books is that this isn't something strange or abnormal. This is something that for most countries in the world is seen as just the way you do it. Not everybody went on this strange neoliberal experiment that we went on, where we were told that there's a stable pool of money and a stable pool of goods, and if we create more money, then the price of the goods will go up. And there's only so much of the money to go around. Well, no. Money can be created provided you are creating new capital goods, you are creating new value. So, for me, it's been a trip that I'm still on, learning about this, but public banks, in my view, could be an incredibly positive way for Wales and other nations to improve their development. And it's just about us understanding that basic credit function and making that work instead of for a very tiny minority to make it work for society as a whole. Now, don't hear any more from me because we all want to hear from Ellen Brown, who will explain all of this far better than me, and she's also probably drunk less wine. So I'll leave you with Ellen Brown.
So I'm president of the Public Banking Institute. We've got a quite vibrant public banking movement going in the US. We've got 20 states that have introduced bills of one sort or another for publicly owned banks, and now we're working on cities. We haven't actually gotten any public banks established, but we've gotten close. My state of California introduced a bill for a feasibility study, which passed both houses of the legislature, but the governor didn't sign it. He said we already had a banking committee, we didn't need more committees, and that we could do it in-house. But of course, that was the last we heard of it. But we're still working. And then I ran for treasurer, state treasurer, on the Green Party ticket. Of course, I didn't get it. 34 million people in California. But I did get an introduction to the treasurer and some other good contacts. So we're working on it again, and we're hopeful. So I think Wales is also in a very good position right now to be considering a public bank, partly because of devolution, where you're getting more financial sovereignty, sort of, and partly because of the fact that there's all this discussion of leaving the EU. So things are changing. Obviously, people are dissatisfied with things the way they are, so it's time to be considering a new model, of which I would propose a public bank. The neoliberal solution is austerity, tighten our belts, sell off public assets, downsize, lay off public workers, liberalize, which means like open up trade. And that in turn opens up the door to corporate property grabs. Once you privatize, then they can buy all this stuff. And we now have these ominous trade deals that are really corporate power plays, masked as trade deals. So it's the TPP, the Trans-Pacific Partnership, the TTIP, the Transatlantic Trade and Investment Partnership, and TISA, the Trade and Services Agreement. That TISA might be the worst of the bunch, in fact, which will, so once these big corporations have bought everything up, then these trade deals make sure they get to keep it. When we, the people, get dissatisfied with privatized trains and privatized water and privatized electricity, and we try to go back, we can't do it because of the terms of these deals. They've been negotiated in high secrecy. The assuming it passes, the tribunals are not ordinary courts where you have the right of appeal and attorneys and so forth. It's just 3 corporate lawyers are the judges or the arbitrators, and they'll go back to working for the corporations when they're done, no doubt. So they're not exactly neutral, and the governments themselves can't go into these tribunals and bring suit. It's only the corporations that can sue governments for infringing on their profits. So any sort of legislation that might, for example, environmental legislation or things that protect your health. If they infringe on corporate profits, the corporations can sue over it. And then it seems to me probably maybe one of the most ominous and least recognized features of these deals is that once you become a public asset, or once it becomes a private asset, if you try to go back to return it to the public sector, then this is considered anti-competitive, so it's against the terms of the deals. And with all this result of this great parasite that's sort of corporate parasite that's taking over everything, I mean, it does look like the goal is to own everything and rent it back to us. And it's all because we don't have enough money. We, the governments, don't have enough money to pay our bills, and we can't seem to balance our budgets. So we have to sell things off. But why don't we have the money? Most people think governments issue money. It looks like they do. They see the faces of presidents and kings and queens on the coins and dollar bills. But in fact, what the government makes is only a very small portion of the money supply. This blue line here, this is US money supply, but UK is similar. And then the red line is the circulating money supply, the money we have to spend. And that is all created by banks when they make loans. Money reformers have been saying that for decades. When I first started, when I wrote Web of Debt, and I would tell people that were trying to approach, like in California, approaching our legislature, they would say, I can't say that, you know, banks create money, they're not going to believe me, they're going to think it's, you know, some sort of quackery conspiracy deal. But now it's official. The Bank of England has actually come out and said, contrary to popular belief, banks do not lend their deposits. They actually create deposits when they make loans. And I think this admission is probably largely the result of the great work done by Positive Money in bringing this issue to public attention. So the bank says, well, we haven't really created anything. It all comes down out to zero. But the check that goes into another bank then becomes a deposit in the other bank. And the way they count the money supply, they count the deposits. So you've actually just created $500,000. And then you say, but don't they have to balance their books? They have to get the money from somewhere. They do, but all banks are doing this at the same time, and they all have checks coming in at the same time. So you have checks flying back and forth all day. So you might have created a $500,000 check that went into Bank B, but Bank B might have created a $500,000 mortgage that became a check that went into your bank. So between the two of you, it all comes out to zero, but you've actually created $1 million in the form of deposits. Or you might just be short $50,000 or something. And then what you can do is borrow from another bank overnight. So they do this over and over. They borrow and then they return it, and they borrow it and return it. So it's just sort of this ruse to make it look like things balance when really they've created it out of thin air. And if the banks themselves don't have it, well, they can borrow very cheaply, first of all. In the US, even though they've just had an interest rate raise, it's not much of a raise. It's gone up by, it's now something like 0.35% instead of 0.25% that they can borrow at. And in the ECB, the last time I looked, it was 1%. I'm not sure what it is right now. And I'm not sure what the Bank of England is either, but anyway, it's quite low. Less? Yeah. Okay. And it's only banks that have this privilege. So under the Lisbon Treaty, Article 123, which I understand the UK is also subject to, even though you're not part of the Eurozone, only banks can borrow from the central bank, whether it's the ECB or a national central bank. Member governments can't do it. So what's wrong with this model? First of all, the problem of perpetual growth. If all money is created as a debt, or it's all created as loan, then in order for those loans to get paid off, all that money has to be returned to the system. In other words, all the recipients of the loan money have to spend it back into the economy, but they don't. For one thing, people save money. They may lend it instead of spending it, so they re-lend it, or they may invest it, or it may go into offshore tax havens. And then there's the problem of interest. When the loan is created, only the principal is created, but over the course of a 30-year mortgage, you're going to pay back as much in interest as you pay in principal, and you've got to get that extra money somewhere. I know there's this whole theory that you can recirculate it somehow month after month, but that's just not the way it works in practice. There's a lot more debt than there is money to pay the debt. So somebody has to continually be taking out new loans in order to keep this whole system going. And that's what happens when it all crashes. It's because you've run out of debtors, basically. So you see this sort of exponential curve or exponential growth in parasites, cancers, and compound interest. So when the parasite runs out of its food source, you hit the wall and the whole thing collapses. And then the banks start all over again. But meanwhile, they've probably foreclosed on your property. Second of all is the issue of control. Private bankers determine where the money goes. But legally, when you put your money in the bank, it is no longer your money. It becomes the property of the bank. And all you have is an IOU, or a promise to pay. So the bank can then do what it wants with this money. In the US, it used to be that the Glass-Steagall Act prevented banks from actually gambling with deposits, but the Glass-Steagall Act has now been repealed. And in fact, the last part of the Dodd-Frank Act that would have kept banks from doing derivatives with the deposits has also been repealed, or I forget, rolled back, I guess they called it. So they can do practically anything with your money, our money, and they do things like they're buying ships and putting oil tankers where they've got oil in the ocean, so they can manipulate the price of oil and other commodities. I mean, they're doing all sorts of things with our money that are very risky and very profitable to them, and if they happen to make a bad bet, the people wind up picking up the tab. They determine who gets loans and on what terms, so they can make very cheap loans to themselves and expensive loans or higher priced loans to the rest of us, or they can refuse to lend at all, which then results in recessions or depressions when there's just not enough money out there. And then third is risk. If when they fail to be able to balance their books, or when they make a bad investment, we wind up picking up the tab. So that in bailouts as of 2008, and now that governments have gotten tired of bailing out the banks, the new thing is bail-ins, where they actually take the money of their creditors to recapitalize themselves. So it used to be the bankruptcy was all about, if you were a bankrupt bank, you would liquidate your assets and pay off your creditors, who would stand in line according to seniority. But now it's the other way around, where the bank does not actually go out of business. The bank stays in business by confiscating the money of the creditors, which includes the shareholders, the bondholders, and the largest class of any bank is its depositors. So we first saw that in Cyprus, and there've been a number of bail-ins since. I actually I wrote about this recently, where there was a man hung himself and left a note blaming his bank. He lost 100,000 euros in a bail-in where he had bought bonds of his bank, where he had banked for 50 years. But it was really the fault of this Eurozone banking union, where the bank was required to do these bail-ins. The template for the bail-ins was established in 2011, and it was approved by the G20 in the fall of 2014 in Australia, Brisbane, Australia. So it's basically the law. That's what the bank has to do. And starting in January of this year, they're actually taking not just the bondholder and shareholder money, but the depositor money. Theoretically, you're protected by deposit insurance, but the EU banking union that was entered into in the spring of 2014, it was supposed to have 3 pillars: bail out, bail in. Before you did a bail out, before the government had to pay, before the taxpayers had to pay, the bank was supposed to bail in its creditors' money, and then this would exclude, or then your deposit insurance would compensate the people who were within the deposit limit. So that would be 100,000 euros in the Eurozone. I think it is 75,000?
75K.
75,000 pounds in the UK. But they never agreed on the Eurozone-wide deposit insurance. So all you're left with is the deposit insurance of your own country. So if you happen to be in Greece or, say, Iceland, you could be out of luck, even if you are within the deposit limit. And the big threat that people don't talk about is the threat of the derivatives, which this is the US, of course, and this chart's a little bit old, but currently the FDIC, our insurance fund, has $67 billion in it to ensure that the green block is, so that's the little blue line that you can barely see. The green block is all the deposits, but about half of that is covered by insurance, like it's within the $250,000 insurance limit, so that's about $4.5 trillion. And then the big risk is this great big mountain of derivatives, which it's now $247 billion, but the GDP of the entire world is about $60 billion. So that is huge, and that's, of course, that's in the US, but you've got, your big banks are also gambling in massive derivatives, and it's the same rule applies in Europe as applies in the US, that derivatives go first in a bankruptcy. I mean, this is just part of the contract. So derivatives are private contracts, and they have written right in there that if there's a bankruptcy, they get to grab the collateral. And they're considered secured, so they take all the collateral first. And these are largely, the derivative players are the big banks. So the banks get their money out first. And if there's anything left over, then it goes to the other secured creditors first, which would include the local governments. So they are secured, but the security of the derivatives trumps the security of the local governments. So that right there is a good reason why local governments should have their own banks instead of putting their rather substantial deposits in Wall Street banks or high street banks. And then, of course, the FDIC comes after that, or the insurance, whatever, the deposit insurance. So one theory is that we can fix all this by preventing private banks from creating money at all. But then there's the risk of you're going to, this whole mountain of credit created by banks, you're going to have to replace in some other way. I know I've heard theories of how you could do it, but a more natural and less disruptive and it seems more likely to happen alternative is to eliminate or to recapture the ability of banks to create money by owning the banks. We the people should own the banks ourselves. So allow the banks to create money, but we own the bank, we get the interest back, we direct where the credit goes. It goes for public purposes. And this is actually legal under the Lisbon Treaty, Article 123, which it forbids member governments from borrowing from the central bank, or like the ECB or the National Central Bank, which would be the Bank of England. But it allows public banks, it excludes public banks from, in other words, public banks are considered banks, so publicly owned banks can borrow from the National Central Bank. So you get all the perks of a bank. That would also be true in the U.S., but I had to make sure it's also true here in the EU. The ideal model goes back to Benjamin Franklin, who actually got it from Bishop Berkeley of Ireland, who had come to the colonies, and Benjamin Franklin quoted him, and Adam Smith quoted him. So Berkeley was actually the original public bank person. But the Quakers themselves were bankers, and like the Jews, they were excluded from other businesses, so they had gone into banking, but they had developed this other model, which was more publicly community-oriented. So in their model, the colony of Pennsylvania, all the colonies were issuing their own money, but it was easier to issue the money than to pull it back in taxes. So they did tend to devalue their currencies. But in Pennsylvania, they developed this system where they owned a bank. So most of the money went out in the form of loans to the farmers, and then it came back, so it could keep recirculating. And in fact, there were hardly any banks at all in Pennsylvania then. So you just didn't have access to credit, you didn't have access to money. So this is just my own little model, but let's say you started with $105, you just print $105, then you could lend the $100 at 5%, spend the $5 on roads and bridges, and it would all be out there to come back as principal and interest. So then you could lend the $100 all over again, spend the $5 all over again, it would all come back. Spend the 100, lend the 5. So you have a sustainable system. You don't have to have this perpetual growth imperative in order to
inflation doesn't get in the way.
keep money in the system. Sorry. And during that period, it was like 50 years, they paid no taxes except an excise tax on liquor. There was no inflation as a result of excess money in the system. There was some inflation from shortages, and there was no government debt. So it was basically the ideal model. And could that work today? I would say it actually could. Of course, these are US figures, and I did this in 2011 or 2012, I think. But at that time, total taxes in the US were $1,100 billion. Total interest collected by the banks was $725 billion. Total interest paid on the federal debt was $454 billion. So if the government were borrowing from its own bank, it would get the interest back. So if you combine those two, it's more than $1,100 billion. So you could actually replace taxes with interest if you had a completely public banking system. I mean, that's not going to happen anytime soon, but the point is that the model would work. Globally, in fact, 25% of banks are publicly owned. In the 1990s, 40% of banks were publicly owned, but then we went through this wave of privatization. But even now, 25%, largely in the BRIC countries, Brazil, Russia, India, and China, which also contain 40% of the global population. And these countries managed to avoid the credit crisis, at least originally. Now, of course, China is succumbing like everybody else, but originally they lent counter-cyclically. They put money out there when the other banks were pulling in their horns and kept the economy going. The largest banks globally are also state-owned, including the two largest banks by market capitalization, which are in China. The largest bank by deposits, which is Japan Post Bank. It's sold off, I think, 11% of its shares now, but it's still majority owned by the government, and we could go into, it's pretty nefarious why they're even selling it off. But anyway, it was an excellent model for many years. The largest bank by number of branches, which is Bank of India, largest development bank, which is in China, and the world's 7 safest banks, led by KfW, Germany's public development bank. it's also that countries that have gone from extreme poverty up to middle class or, you know, thriving economies are also economies with strong public banking sectors, economic miracles. So that would include China, Korea, Taiwan, Singapore, Hong Kong, post-war Germany and Japan, Brazil, and Argentina. China is the global leader. That's this red line that just cuts through everything else. That for 30 years they were growing at 10% a year, which is just unheard of. And even last year, when they're supposedly slipping, they were growing at 6.9%, which is better than anybody else. Then there's Korea, which had a 14-fold per capita income increase in 40 years, something that took Britain 2 centuries to do and the US 1.5 centuries to do. Ha-Joon Chang he's a Korean economist, he wrote a book called Bad Samaritans, and he said that their secret was that the government owned all the banks, so it could direct the lifeblood of business credit. And that was also the Japanese model. In fact, they got that from the Japanese. The idea that before that, India thought you had to own, you know, the commanding heights of the economy, so you would own the major industries. But the Japanese figured out that you didn't really need to do that. All you really needed to own or be able to control was the credit system, and then you could leave the other things private, and you could still direct the growth of the economy. So in the US, we have one. If we didn't have this one bank, I would not be talking about public banking. The Bank of North Dakota. I knew that North Dakota was the only state to have its own bank. I learned that at an American Monetary Institute conference. And but the man that told me said, "But oh, it's just an ordinary bank. You know, they just do what everybody else does." And when we had the credit crisis, it was the only bank, or it was the only state that stayed in the black when all the other states were slipping into the red. And so I started watching it and discovered all these other remarkable things about it. It had the nation's lowest unemployment rate, one of the lowest foreclosure rates, the lowest default rate on student debt and credit card debt, which it still has, all those things. It was set up in 1919 by the Nonpartisan League. This was the farmers got together when they were losing their farms to the Wall Street bankers, which was basically a cartel. It was a Rockefeller bank, a Rockefeller railroad, and a Rockefeller granary that were taking their grain unfairly or not paying them appropriately for their grain, or the railroad was costing so much that they weren't making any profit. So they were losing their farms, so they decided they wanted to keep their money in the state. And they set up a bank. They won an election and set up a bank. So North Dakota is actually very conservative. It's not a socialist state at all. But the idea was state sovereignty. They wanted to keep their money for their own purposes, something that Wales could also do under devolution and would no doubt come out the better for it. So the model is that by law, all the state's revenues are deposited in the bank. So it has this massive deposit base, and then it does like all banks do, which is create credit for the state. And it has a mandate to serve the public. It directs this credit to particular sectors that it supports. So agriculture makes 1% loans to startup farmers, 1% loans to energy, particularly green energy, low interest loans to students, variable rate. Those are all sectors it particularly supports. And during the last decade, it has had a return on equity of 17 to 26% and has returned $40 million annually to the state, which may not sound like a huge amount of money, but this is a state of 640,000 people, so it's quite small. The Wall Street Journal in November of 2014 had an article that said that the Bank of North Dakota is actually more profitable. Oil has done quite poorly. plunged. And yet, the Bank of North Dakota has had record profits every year since 2003. So in December of 2015, they reported their most amazing profits ever. So it was not because of the oil boom. The Sparkassen Banks of Germany, it's a little different model. They're more local banks, but they too are doing remarkably well. I think they have 40% of the commercial market, the banking assets in Germany. And they too had a study in January of 2015 reporting that the Sparkassen banks were doing better than the private commercial banks. That would include Deutsche Bank and the big banks. So you can see it, there were a number of charts, but I just picked one out. This chart shows that the orange is the Sparkassen, the local public banks. And the green are the credit unions, and the baby blue is the commercial banks. So the commercial banks they did well up until the crash, and then they did extremely poorly, and then they're just eking along since then. And you can see that the Sparkassen are doing much better. Other models globally, Australia, New Zealand, and Canada today the EU says that, or the Eurozone rules, or I guess the EU rules say that you can't borrow from your own central bank, but previously, in the first half of the 20th century, Australia and New Zealand and Canada did it with quite remarkable results. Australia and New Zealand both got blocked by the Bank of England, but Canada did it from 1939 to 1974, so a period of 35 years. There's actually a lawsuit going on right now to get them to return to the mandate of the Bank of Canada, which was to make loans to the government and to local governments interest-free. So during that time, the debt, people think, that they use the credit of the Bank of Canada to do all sorts of development, and this whole list of things, including the Trans-Canada Highway and their remarkable healthcare system. It was remarkable, it's kind of slipping now because they're now running out of money. But so with all that development, their debt remained low and stable all the way up until 1974 or so. So what happened in 1974 was that the Bank of Canada joined the Basel Committee and the Bank for International Settlements, which had new rules that you weren't supposed to borrow from your own central bank or issue your own money. You were supposed to borrow from the market as if you were borrowing existing money. But in fact, as we now know, you're still borrowing money that's created out of nothing, but now you're paying interest on it. So the result was that well, you can see on this chart, the debt just shot up. And it has been argued, could be shown, that if we were borrowing all along from our own central banks, we might have no debt today. In France, well, in Canada, in fact, they'd have a nice surplus, as you can see, comparing what's been paid in interest and the actual debt. And in France, this was for Bernard Liotard's book, Money and Sustainability. What France has paid in interest between 1979 and 2009 is equivalent to the current debt. So if they had not had to pay this interest, in other words, if they'd been borrowing interest-free from their own bank, they would have no debt today. If you are a government borrowing from your own bank, you can save 40% on average on the cost of public projects, according to Margaret Kennedy, who was drawing from the Bundesbank. Unfortunately, she's passed away, our friend. And if it's infrastructure, in California anyway, it's 50%. And I've seen that in studies or in articles that this is actually just accepted as what the cost of financing is. 50% of the cost of a project is financing. So, for example, the Bay Bridge had a wing of it redone. It looks very pretty, but it was supposed to be $6 billion. And by the time you add in interest, it's $12 billion. And the California bullet train, which has barely gotten off the ground, it may never get off the ground, was $10 billion. That was what the voters initially approved, and by the time you add an interest just on that 10 billion, it'll be nearly another 10 billion. Recent studies, some of the older studies were negative on public banks, but the recent studies, well, those were actually, I'm thinking of a World Bank study, which may have been a bit biased, but the recent studies show that public banks are actually safer than private banks, less corrupt, more profitable, more efficient, and better for the local economy and better for the local government. It's often asked, how do you keep the bank honest? How do you prevent it from politicians getting in there and making loans to their friends, as has happened historically, but this is in places like Africa where you can't really see the books or you can't really control what's going on. But today we have the potential of 100% transparency. So with the internet, you can envision a system where it's all up there on the internet and anybody who wants to could look. And first of all, what you need is rules limiting what they're allowed to do legally, and then put it all up on the net so you can see what they are doing, and if they're breaking the rules, you get rid of them or take them to court. I spoke in Iceland along with a man from the Sparkleisen group, and he said, and they don't have a corruption problem, and neither do they in the Bank of North Dakota. And he said, it's not that we're more moral than anyone else. He said, we have rules, and there's what they're allowed to do does not allow them to speculate or make loans for their friends and so forth. I was told by an elected official who will remain nameless that he said, okay, we're interested. He said, if you can show me how I can do this, or how we can do this without putting up any money and without taking any risk, we'll do it. So here's my model for what they could do. In California, it's $20 million to capitalize the bank minimum. So let's say this is a pilot project. So you raise $20 million with a bond issue at 3%, let's say. So your cost of capital is 0.6 million. Then this allows you to pull 10 times that amount in deposits of your own. This is your own money. You just pull it out of JP Morgan or wherever it is and put it in your own bank. Then hold back 20 million in reserve. This is the 10% capital requirement. So you can lend 180 million, but instead of going to the trouble of lending it and finding borrowers and worrying about risk and so forth, just take that 180 million and buy municipal bonds with it at 3%. So you've created $180 million, which you've invested. So your profit on that is 5.4 million. Your cost of funds is 1.2 million. So you've just made a 21% return just from one guy sitting in an office shifting your own money around. So that is the potential that we're giving away by giving our deposits to essentially foreign banks or private commercial banks that are designed for profit, and they are making this sort of profit on our money. We could be making that profit ourselves. So I'll close with that line from, it was quoted by Michael Hudson, I don't remember who he got it from, in his latest book. He said, if we don't own the banks will own us. So that's pretty much where we are today. So this is my website for more information, Public Banking Institute, ORG, for information on setting up a bank, etc. My blog is alanbrown.com, where there are over 300 articles, and these are my 2 books on the subject. So So that's it.
Timothy Morrill. One question on the Bank of North Dakota. If it's using other local banks as a front office, aren't those banks essentially having a conflict of interests because they're in essence doing business for the BND rather than for themselves at a higher rate of interest?
Well, these are private commercial banks which make these loans, and then the Bank of North Dakota just comes in and partners with them. In what way? I mean, it's not. There's nothing illegal, or I'm not sure why it would be corrupt.
No, I wasn't saying it was corrupt or anything, but conflict of interest in terms of, for example, if you walked into a Lloyds bank and said you wanted to invest £250 every month for 12 months, they have a product which, if you're a common or garden non-fee paying current account customer, would pay 2%. TSB, which was part of Lloyds until it was demerged, have a similar product that pays 5%. So if you were directing your customer to the right place, to their advantage, you'd be sending them to TSB rather than filling it yourself. But obviously that would be frowned on. What I'm trying to say is, wouldn't the local banks that act as a front office for BND be depriving themselves of the business?
Well, they're not really the front office. I'm just saying that it's the local banks. The BND lets the local banks, they don't compete with them. They don't try to take their deposits. And in fact, they tell us, if you want to set up a bank in your state, don't compete with your local banks. You need some constituency that's going to be in support of this idea. And if you tell the local banks that you're going to help them, strengthen them against the Wall Street banks, which are now gobbling up the local banks because they can't, for one thing, they can't fight these regulations that are massive paperwork. They really have nothing to do with the local banks, but they're killing the local banks. It looks like on purpose to force them to merge with the bigger banks, which can afford to deal with the regulation. So the BND is the friend of the local banks, partnering with them, but not literally partnering. I'm just saying they work together as opposed to stealing their loans or stealing their depositors. They let the local banks do all that, and then they just come in. They help with capitalization in the sense that they guarantee the loan. So they don't need capital. Like, it's a big loan that they don't have the capital for. So the Bank of North Dakota comes in and says, well, we'll guarantee it. And so they don't need capital.
So in other words, where one loan might be a large amount in proportion to the local bank's capitalization, the BND have guaranteed it, so there's no financial risk.
Mm-hmm.
Therefore, they don't need to make any provision for bad debt on it.
Right, they don't have to set aside capital that they don't have. You can do that, you can do that. You can go to the Federal Home Loan Board, for example, and get them to guarantee your loan instead of having to, I mean, it's a known thing that's done where a big bank can guarantee a loan and help out a smaller bank, yeah.
Okay, any question? Name's Simon. I have to say that a public bank for Wales would be a far cry better than what we currently suffer under. There's no doubt about that. But the one problem I see with the notion of a public bank, can you hear me all right? The one problem I see with a public bank is it doesn't get away from the basic tenet that all money is debt. It doesn't treat us as debt slaves. We just have basically a more benign slave master, which is the state perhaps. but it doesn't get away from an almost psychotic kind of economy, and suicidal, ultimately, economy, where we have to continually grow to pay back our debts because interests are mounting up. And although it's like I say, it's a lot, I see a public bank as a solution, as a part solution, but doesn't get away from that the black hole of debt that really is strangling the planet, basically.
Well, if you see money as what the real function of the bank is to determine the creditworthiness of the borrower. It's really the borrower who creates the money. So when you go to the bank and take out a loan, what you're really doing is, if you go to the grocer and try to pay with your IOU or promise to pay, the grocer's not going to take it. But some economist said that anybody can create money. The trick is to get other people to accept it. So if you go to the bank is legally allowed to turn your IOU into money, and that's what they do, and that's how they expand the money supply. So it's really, you could envision, for example, a community currency system where all that is debt. I mean, there's no money in the system, and then if I say, if you'll wash my car, I'll give you 5 credits, $5 worth of credit, then suddenly we've created $5, but it's a debt for me to you, or for me to the system, and so I have to do something else for the system in order to pay off my debt. But it's a good thing. It's quite sustainable, and if the interest is paid back into the system, that part is sustainable. But it seems to me where the things get hung up is partly because a lot of people don't pay their money back into the system, and for that you really do need to put some extra money in there, which is what the social creditors have been saying for 100 years. And so you can do that with a national dividend, or with quantitative easing for the people, or quantitative easing for infrastructure, different ways. It seems to me you do need some body at the top, monetary authority, issuing some extra money, handing it over to the government to spend in some publicly oriented way to keep the whole thing sustainable.
I'm going to take 2 questions at once, if that's okay. I'll take one from Birt and then here. You can answer them both at the same time.
Hi Alan, it's Griff here. We know each other obviously. From Arian Cymru. Would you be happy to remind people how this could apply to Wales right now and the devolution settlement? We talked about this earlier. If there's a capital, if the Welsh Government can find, say, 100 million, they can leverage out £1 billion in loans, or if they find £1 billion as capital, they can leverage out 10 billion. Could you maybe elaborate how that could be done right now and carried out in Wales?
Okay, well there's actually talk, I understand, of something in the nature of an infrastructure bank, right? Or what, I don't remember what it's called here. We have an infrastructure bank anyway in California. It's publicly owned, it's called an infrastructure bank. And what happens is they have a pool of money, they lend it out, and then when it gets paid back, they lend it again. So you've got X amount of money, and that's all you ever have, and you keep relending it and relending it. But if you form a bank, what you can do is take that same pool of money, put it in the bank, and if you're a local government, or a government, a national government, you can then pull 10 times that amount of your own deposits. You don't have to go looking for these deposits. This is money that you've already got in some other bank. Pull it out of that bank, put it in your own bank. Now you are allowed to make, holding back 10% as reserves, you're allowed to lend 90% of that. But you're not really lending the deposits. That's what we now know from what the Bank of England has conceded. You're actually doubling your money, except for the 10%. You're actually doubling, you've got the revenues equal to X amount, and you just doubled it in the form of credit or loans that's going out there. And you can cover that by borrowing from other banks. You're allowed to do that because you are a bank, and that's what the banking rules say.
Question here?
Hello, my name is Noel Thomas. Thank you very much. It was a brilliant exposition, if I may say so. I've been a student of your writing for many years, a very poor student. Whenever I've met friends, colleagues, I've always raised the subject of banking. No one I've ever met has got the least notion, the least clue about how banks work. I've tried occasionally to start a dialogue with financial journalists and people who are supposed to know about this sort of thing, and supposed to educate the public. But of course, journalists are not the most courteous of people, and they usually don't reply, or if they do reply, they make no sense. Now, I'm wondering if journalists, if journalists are really as ignorant as they appear to be, or if the big banks do lean on them in some way, and perhaps suggest they won't be invited to so many coffee trips and conferences in Mauritius and things like this. Do you have a feeling, do you have an opinion about this that you're prepared to express?
Well, I would guess that they probably don't understand because they haven't, and if you haven't studied it, because everybody assumes that money is created by the government. I mean, we're brought up that way and nobody taught us otherwise. We don't learn about it in school. They don't tell you where money comes from. My son's, he got a master's degree in economics and he was going on for his PhD, but he didn't finish because he didn't like his subject. And I said, oh, I know some great subjects, you could write on these different banking subjects. And he said, Mom, I didn't study banking. Like, banking is a specialty that you can go all the way through graduate school in economics and not study how money is created. That's something they learn, I guess, in banking school, or what do you call it, business school.
You certainly don't do business school.
Oh, they don't? Yeah, so I don't know that they...
Nobody does it, full stop. I'm going to go to Reem, and then to Jane, and then Ian, and then...
But I imagine they also, I mean, you certainly hear of journalists being suppressed, or they write about something and somehow it doesn't wind up getting published. I mean, I'm sure there's some control mechanism at the top that filters out things they don't want said for any savvy journalist who might actually catch on.
Rhina Bionwerth, Shadow Economy Minister for Plaid Cymru, the Party of Wales, former journalist, 20 years. So I'm still a member of the National Union of Journalists, so we'll have a word afterwards. My party has been advocating the establishment of a National Bank of Wales for some years. I see it as a step up from what we currently have, which would be Finance Wales, which is the model that you just outlined, which uses a capital base to lend and so on, a fairly simple model, and I'm very eager to develop that into something akin to a North Dakota type bank. Now, I'm interested politically in how to overcome some of the barriers to setting up such a bank. In a speech a couple of months ago, a month or so ago, I said that if we were to get our hands on the levers of power, setting up a National Bank of Wales would be one of the first things that we would want to do. What are the main barriers from your experience in the United States, where you say legislation has been passed in several states, but nothing's actually been done?
Well, we're on our second round of attempting to get these bills passed, and I think one thing that we need to do is get a groundswell of support before we go out there. And I mean, this is just for us. Your barriers, I'm not sure, but it seems to me you got to get all your ducks in a row first, and that's probably a mistake that we made because we were so eager, and it all looked like it was falling into place, and we have all these volunteers, that run out and make claims that aren't necessarily correct, and then the banking lobbyists counter with something and they don't really know how to answer. So we need a team of experts that can, well, in California, that's the stage we're at, where we need a business plan and just all the details, the numbers of how much you're going to make this way, doing it this way, and what it'll cost and what the risks are, just laying out all the benefits. But I'm sure there are also political barriers of which I don't know. Well, the big banks have all the money. I mean, why is it that Bernie Sanders probably, anyway,
it's lack of ambition and conformity mainly that is the political barriers. Lack of ambition and sort of conformity are the biggest barriers.
And the big money owns the media, so they can always twist things, and politicians are not most people don't understand how banking works, and so they're going to buy whatever the media says. If the media says, "Oh, we don't want the government to get into that," well, that's what I heard quite often, or arguments to the effect of, I don't trust government. We don't need more banks. That's just what lay people think without having been educated in the whole thing. So we need an enlightened populace for starters.
So we got some questions from the front, got one from the lady here, and then we got Ian, gentleman here, then on the side.
If we were to set up a National Infrastructure Bank of Wales, or even a Public Bank of Wales, you can't put assets that are not financial. And can you put buildings and things into this bank as your, or does it have to be cash?
For capitalization?
Yeah.
Well, I think under the Basel rules, I think it has to be, you've got your tier 1 capital.
It has to be bits of paper.
There has to be a certain amount that's totally liquid, and buildings aren't liquid.
Because it always occurred to me, because I spent a long time trying to work out how we could have a Welsh pound. And it occurs to me that Wales is terribly rich in wonderful countryside. I mean, we could provide all our own energy if we just had our wits about us. And all the things that everybody wants, like fresh air and wonderful scenery and space and all the rest of it, but we don't have the bits of paper. So I wondered if we could put public buildings and things like that into the bank as to back the currency or to back the bank.
Well, you certainly could if you became sovereign. I guess you can do whatever you want. But right now, there are rules that are, if you ask me, the rules are designed to make sure that public banks don't pop up and that the big banks retain control.
Following on from what Reen asked really in terms of what the obstacles would be or what you need to overcome. First of all, there's the false ones. And when I start talking about this, people say, "Oh, European law will stop you doing that." Obviously, that would be a surprise to the Germans. If you were suddenly telling them to close their public banks, I think they'd probably pick up their ball and walk. The problem that Wales would really have is what would constitute the depository base. Now, Welsh Government is funded by a block grant from Westminster, who are highly unlikely to allow that to be used as a depository base. It's possible, but I think it would be a tough argument. Of course, Welsh local government has some of its funding from central government, but also has taxation powers, so it has a base from that. So in some ways that would be a more likely source of a depository base. The problem is that by law, local governments are required to deposit their tax take in one of the 5 high street banks.
Oh no.
Oh yes. So they're actually legally required, because of course they're such safe institutions and they have a fiduciary duty to us. So we must ensure that they put somewhere that isn't just going to blow up and go, "Oh, hang on." But that's the requirement. Local government's also required not to, get involved in arcane financial instruments. But if you look into lender option, borrower option loans, you'll find that they go into those head over heels. So I don't know. But that's the main problem that you're going to have, is what is going to constitute the, and it's going to need a legal change, which will need political campaign and political will, because currently
the local authorities still have the same requirement to deposit.
Interestingly, quite recently, the local governments in pension funds have been told they are not allowed to divest from fossil fuel investments, because that would be illegal and risky.
That's why what's
You must leave it in fossil fuel investments, which
what's
are...
required is populist movement that says, that's the law, we don't care, we don't like the law, it's a bad law, change the law.
I'm Wayne, I try and work on interesting campaigns in the student dining room. In terms of, I following what Reen said really, so I agree with what, following on from what Reen said. A bit of trivia as well, which might help. The first cheque, I think, ever written was from Lloyds Bank to take money from Llandudno to London because it was safest. That was an example of Welsh innovation, and that was based on success. There was in the US, this North Dakota thing, sounds like it came from the exact opposite, where the fear of God or the fear of failure made them work together. Now, have you got a gut instinct of
which would work better? Because if you want a ground sort of public support, and I'm one of the people who's trying to generate interest, I suppose, would the positive money campaign is obviously saying, you know, it's a great thing. But looking at the farms in the US, that was fear, wasn't it? Which the two might work better, you know, if we're trying to get the, similar to the Californian bank, trying to get through, because a lot of things what we talk about, anyway, that's the question. You would, the fear of what if it never happens, or the positives work better, do you think, for a public or popular campaign?
Well, it seems to me that probably things are not going to change until we have another crisis, and that's likely. I mean, a lot of pundits are predicting that things are going to fall apart again. And then whatever, Jeremy Corbyn or Bernie Sanders says, some leader of that sort could capture enough of the popular imagination to actually change the system. And then once somebody had done it, and it, I mean, I'm just waiting for, I'd love for Wales to do it, or Iceland, you know, or some small little experimental system that do it and have it work out well, and to have an economic miracle like we've seen historically, like particularly in Asian countries. And then it seems to me everybody else would do it. If you were in the midst of a crisis, you know, I was going to write an article on this, but I never got it out there, but every 20 years on average we've changed the monetary system in some way. So we could do it again, and probably will do it again when enough people realize that the current change, I mean the last big change was 2008. It was unbelievable the things they did, that like bailing out, or like the Federal Reserve bought an insurance company for $80 billion. I mean, who ever heard of a central bank buying an insurance company? AIG, but they did these things and bailed out the banks, which you're supposed to actually let them go bankrupt. That was the law, or nationalize them, but not bail them out and keep them private. So probably the most radical change was in the 1930s when, in the U.S. anyway, when Roosevelt closed the banks, and when they reopened, he said, new rules. We're not going to have gold anymore. No problem. You know, we won't be out of reserves because we're not going to use gold for the reserves. We're going to go off the gold standard. So we can do that again. You know, we could say new rules. The next time it all collapses, we'll say new rules. You've tried it. We've watched you with all these regulations. The regulations haven't worked. The big banks are just getting bigger and riskier. And you see what happened. You just collapse, whatever, assuming they collapse. So we're going to have to do it a different way. This time we're going to turn you into a true national bank.
I mean, one of the issues is that a lot of people talk about public banks as they are sort of state banks, as you were talking in the United States. It seems to me the terms that we should be using is things like social ownership. Now, social ownership would then start talking about community banks. Yeah, we would be talking of the same principles that we're following, but the direction is that you would be building up from the bottom. So you would start very small community banks, and that itself would constitute, if you like, the Welsh community bank in the end. And that may be the way also to surmount some of these regulatory obstacles. Because if you started small, in a town or in one of the sort of larger areas of Wales, you could build that bank up. So I'm very keen that the definition actually does mislead people in a way, because even the Bank of England is a public bank. It's, you know, technically owned by the Bank of England nominees, but it's supposed to be our bank. But that's not what we're talking about. So I think we should get back to using terms like social ownership. That is a term that's usually associated with I am a socialist, and that's a term that's associated with socialism. And of course it is peculiar that you do have social ownership in Dakota, even though the people are Republican and right-wing. So I think we can, by using the right terminology and the right approach, overcome. I think there's some very, I mean, he obviously talks about some very practical obstacles with local authorities. I'm having to deposit their money in the tribe. But one of the issues that has arisen there, of course, is all these local authorities that put their money into derivatives. And actually, a lot of local authorities were involved in lots of speculation, and there were big losses. So you know, I don't think it would be difficult to mount a campaign around local authorities putting their money in more secure places. So it's really, I hope that people here who are, I'm sure, know much more about money in Wales than I do, start to work on some sort of practical plan. It's only a discussion document, really.
It's a very large amount of money on deposit too.
Right.
Which is effectively a loan from the local authorities to banks, because that's what we do when we put our money into a bank.
Well,
It's not
I
money
think
in
a strategic defensive for Wales, because I believe that the City of London, again, is going to go through another very serious crash. And its effect on the Welsh economy will be horrific, because all our money flows into London from Wales. There is no institution in Wales that is genuinely a community institution that could actually help Welsh people in the event of a serious financial collapse. So I think we've got plenty of arguments, but we don't really have yet the right wording and the strategy, given that there are obstacles. But there is another one that's obviously concerning you much more about this. Is this whole question of the European level and the European Central Bank. Even we are not part of the euro, but you are saying that actually we still, through Lisbon and other things, are bound up with lots of the financial regulations that come from Europe still.
Alan, can I just stop you there so I get a couple more
Yeah,
questions before the end?
okay, it's just so, it's what your view is on this direct question, because that's the one that's really topical. Will the European Union, voting yes for staying in Europe, which I believe is Plaid Cymru's policy, help us towards getting a social bank or in Wales, or will it heed it? Is it better that we vote against it on that basis? My feeling is that that if we were out of Europe, we would actually control more things and would be able to create more of a bank. So I'd like Cymru to rethink its policy on that as well. So is that your views?
Yeah, and well, I think this whole threat of the TPP and the TTIP and the TISA is reason alone to leave the EU if they sign up for those agreements. I mean, just the fact that with the arguments I've heard for staying in, I mean, you know more than I do about staying in, but the arguments I've heard is that, well, a lot of the environmental and health regulations are coming from the EU, but you can do those regulations yourself. If you were a sovereign country, there's a lot you could do. I mean, it'd be remarkable what fun, or how interesting to be able to start from scratch and set up your own system.
Thank you very much, Alan. I'm going to take two comments, questions from these two gentlemen here, and then we'll go back to Alan for a final comment.
Hi, my name's Richard Essex. I've been involved in rooms like this talking about setting up banks, public banks in Wales for the last 15 years. I haven't gone very far, and I think it's best summed up in a comment or just a sentence in a New Economics Foundation report that was released today. The UK is one of the biggest, most concentrated, risky, complex and interconnected banking systems in the developed world. It leaves us uniquely exposed to global financial turmoil. I mean, we had this recent financial turmoil where the British government actually took a high level of public ownership on those banks that failed. Where have they gone now? They've gone back to the private sector. So you can see how the banking system actually looks after itself very, very easily within the UK. And being able to actually challenge the regulatory system in the UK is a huge major challenge in being able to produce something that's really of scale that can operate even in a country the size of Wales. So I think that's a real problem. The second issue is, I know that there are 2 or 3 community banks operating in England at the moment. There is one in Hampshire, the Hampshire Community Bank, which is excellent in terms of what it does, but really it is and I would support it. It's really a green bank. It actually supports activities that relate to the green economy. But it is fairly restricted in what it can do. It's this challenge of how you can get across to a much larger scale in Wales, where you can challenge the regulatory system to make sure that you can actually establish something that is really viable. Sorry, that wasn't a question.
Thank you. Mine are comments really too. My name is Andrew Connell. I work at the Public Policy Institute for Wales here in the university. 3 comments really about the Welsh situation. The first one, it was said by a colleague earlier that one of the obstacles to the Welsh Government doing anything like this is that the Welsh Government is funded by block grant from Westminster. That is true, but it's changing. Some taxes are being devolved to to the Welsh Government under the 2014 Wales Act. There's scope for more, but the biggie, which is going to happen soon, and actually has been generated by Westminster rather than by Cardiff Bay, is the devolution of 10 percentage points of income tax to Wales, and that is going to happen soon if Westminster gets its way. One of the arguments that Westminster has been making, ironically, George Osborne has been making, has been that this will give the Welsh Government a basis upon which to borrow. So that's the first thing. Actually, Wales is going to increase the amount of money which it raises independently. Whether it would be a wise thing or not to put it into something like this, I'm not qualified to comment, but there will be money there. That's one thing. The second thing is the observation that local authorities are required to put their money into the high street banks. I didn't know about that. Under the devolution settlement, and then any future devolution settlement that's likely to develop, the Welsh Government is not responsible for banking, but it does have power over local authorities. The Welsh Government has shown itself in recent years very willing to try and push the bounds of things by saying, well, okay, I could imagine them doing something like this. Okay, we're going to legislate to say where local authorities have to put their money. Oh, I know we're not responsible for finance, but we are responsible for the government. That would probably go to the Supreme Court as a test case, but it might be worth a try. Certainly they did it with spectacular success in a related field a couple of years ago. The third point, small point, it was to do with agricultural wages rather than anything to do with this, but the point is that they very effectively pushed the boundary of the settlement. The third point is you talked about media and popular media stirring up opposition to things like this. Here we have an advantage in that, with the exception of the institutions for which Crean was so distinguished, had such a distinguished career, we have a very weak media in Wales. We don't have a Welsh-based media of any substance. We have one national newspaper which has some pretty good analysis but isn't read very much. Otherwise we have the BBC, we have S4C, we have ITV, which are good but regulated mainstream things. And the London media isn't interested in us. If you add the double thing, A, it's banking, which is complex, B, it's Wales, which nobody is interested in, you can do things under the radar. So my two observations for the rest.
Well, I think that's to finish on 3 positive points. I think is actually an excellent place to finish. I'd just like to thank Ellen for coming a long way to give us some really interesting perspectives on what we might do next. And I think that obviously there are some kind of locally contextualised things we can clearly get on with in your absence and come back again when we've actually got a big plan. But in the meantime, I'd like to ask you to thank Ellen again for this.